Hi everybody, welcome back to the first AMC video on the first day of July. It is indeed the first day of July, and it is also in fact my very own birthday. So there's a lot of exciting stuff going on, and of course AMC stock trading is another thing which is pretty exciting. We're looking at a price increase today of about 10 cents as of current. We did see a bigger spike up to 14.25 this morning. I want to talk you guys through it and talk you through what I think is going on at the moment and why I think the hedge funds are in a worse position than ever before. Again, this is all just my opinion, but if you do enjoy these sorts of videos, subscribe, like and share, because we are of course trying to get the word out to more people. Anyway, we're going to jump in and quickly look at the price. We're just really going to gloss over this one here, no in-depth analysis or anything really, just going to quickly acknowledge what has happened. So we're looking today to hold above 1350, that would be ideal. Again, if this drop can end and we can find the support around this level, which is about 1366, I would say. If we can find that level of support around here, as we have done here and say here before today, we're in a good position to end the day green in my opinion. But one thing that we should remember, looking at the price today alone, we're up by 10 cents. It's not bad, it's roughly 0.5% up to 1% depending on how we are moving. But these gains of 1%, whilst they are wins, especially when the market is in the state that it is, for instance we're looking at these futures here being down quite significantly, to see AMC green is a win. But what we should also be considering is the fact that a gain of below 10% isn't really anything too concerning, and it's not that much of a win. Now, whether you like AMC or not, the fact of the matter is this stock is still down from highs of 70. So we have a lot of room to make up when we're looking at going up higher. And I'm not trying to dismiss green days because they are of course wins, but really people shouldn't get excited about 5 to 10% gains. I think we're looking for more than that on a daily basis. However, the general trend is moving in the right direction. The past month is looking pretty good. Again, especially the past 3 weeks out of 4, we're seeing a very nice pattern forming. We're looking to break above 15 on the high side. We're seeing a lot of difficulty doing that in the past month. Now remember, 15 was previously a level of support. Now it's becoming a level of resistance. We're looking very likely to hold 1250 on the low end, and below that we're looking to go all the way down to 10. As we have held that in the past as well. But that's what we're seeing on price. Not really anything too interesting, as I have said. You guys will know, as I do, we shouldn't get excited about 5% moves, 10% moves, or anything like that. We're looking to see the price increase dramatically. And this is what I think the latest tactic from hedge funds is. It's the boredom tactic. And it really is getting to that point. Closing up by 2% is not exciting. Closing down by 2% is not worrying. Closing up by 5%, not exciting, not worrying for 5% down. You get the picture, right? And that's all that we've been seeing in the past month or two. I think that's the whole plan. To make people just believe, or at least intend to make people believe, that nothing is going on. Now, I'm not going to look at this data too heavily, but it is from JD Ruckus, the Autex guy. We're looking at a 27% increase in cost to borrow for the, or rather 27% for the cost to borrow max, minimum for that figure 15.66, and the average is 18.85. So you get the picture over here. Borrowed change is minus 506k, so that's the figures that we're seeing for today on open. Now, one thing that Autex guy mentions is of course the fact that they are walking down the short interest. Why is that? Well, the user Pedro471 highlights it very clearly. Just so I'm clear, these dummies are returning shares borrowed, not sold short. There is a difference, which they acquired at a lower cost to borrow. They're borrowing more at the higher cost to borrow, but we are the dummies for sure. Now let me do my best here to describe what this means. I'm sure a lot of you will know it already, but simply put, it's a case of they can borrow shares too short. It doesn't necessarily mean that they're going to short them. It's a whole case of having them and not needing them. I think that's the whole idea. They're basically having these shares there to potentially short, borrowing perhaps more than they need to or want to, just so they can increase the short interest, get apes all excited, run the price up by 2, 3, 4, 5, 10% maybe at the highs, and then of course walk down the short interest, walk down the price ever so slightly, and then say, well, nothing's going on. I think that's one of the whole tactics that we are seeing from the hedge funds at the moment. But that's just my interpretation of it. What I'm trying to say is, though, be careful and be wary. Don't think that they won't try tactics to make you think that other things are going on, and of course try and get you away from your conviction. But that's just my opinion on it. I want to hear what you guys have to say. Hope you enjoyed the video. If you did, of course, smash a like and subscribe. But for now, guys, goodbye.